you?
All right, I know it's 5 o'clock for most of the people on the call. So I know some folks are gonna roll in at the halfway mark, so we could probably get started and I can send the webinar out since it's being recorded. Thank you everyone for joining. We are so excited to introduce this opportunity tonight. It's a gorgeous Class A multifamily property. It's 300 units. It was built in 2017. And we're super excited to walk you through it tonight. Just a quick disclaimer that you guys can read later on. So who is speaking? So my name is Sabrina. I know most of you from Apple. I have spent the last 7 years working in tech project management, all while balancing real estate investing on the side. I recently partnered with Charlie and Kyle, and we have created Sabre Equity. It's a fully integrated real estate firm, and we also have a fund as well that we'll be walking you through tonight that we're really excited to announce. So Charlie, I don't know if you want to give a brief info.
Sure. Thanks, Sabrina. Good evening, everybody. Great to see you all here. Probably some repeat people from the last couple of webinars we've done, but I've been in real estate investment since 2007. Started the multifamily syndications about 1.5 years ago. Prior to that, I was syndicating oil and gas deals. You know, with Sabrina and Kyle, we're now looking at not just multifamily, but various different opportunities, but all within the real estate arena. So very excited about this fantastic acquisition that we're part of, and look forward to getting you on board and presenting the opportunity to you.
Hey everyone, I'm Kyle, and yeah, as Charlie mentioned, hopefully you've seen us on the last few webinars we've done, but I come from the investment consulting, investment management world, still active there, but have since begun to focus on syndication, multifamily the last few years, and have had the pleasure of working with Sabrina and Charlie, and look forward to going through this opportunity tonight.
So we've been very fortunate that we've got a good relationship with both Carson and Megan Banks, and they represent Brem Group. They are the other, there's 2 or 3 different other partners on this team, on the lead sponsorship team, and that's how we got introduced to them. Carson's joining us tonight on behalf of Megan and the Brem Group. So Carson, please introduce yourself.
Yeah, thank you. Thank you everybody for jumping on again, just echoing what Sabrina, Kyle, and Charlie said earlier. Really appreciate you taking the time out of your evening to join us and look at this fantastic opportunity to invest in Houston. Like Charlie mentioned, myself and Megan are managing partners of the Brem Group. We're very excited to work with Jay Duara, who's CEO of Aspen Capital. He's got a background in an MBA from Stanford. He's been investing in real estate for close to 4 years now. He's got his portfolio, and our portfolio is primarily concentrated in Texas, and we've really turned an eye to Houston as well, as we kind of mentioned, Dallas and Austin becoming a little bit pricey. And we realized the need to partner with other key players in the Houston. And next slide, please. Which led us to meeting with Ian and George. We've been developing a relationship with Ian and George for close to 1 year now. Ian is the managing member of the Jujeric family office based out of the DC metro area, and him and George have closed 6 or 7 deals together now, primarily focusing on the Houston market as well. And George is the CEO of J&T Construction. We feel, you know, this team that we put together will allow us to efficiently run Parkway flats as well and deliver the returns to you all as the investors. And George, being the CEO of J&T Construction, will allow us to do all of our CapEx in-house, leveraging his company there, so we can keep a meticulous eye on the progress and making sure it's all being done as we planned it out. Next slide, please. Just a little bit more about where we're all covering today. We're going to jump into an executive summary very shortly, following very closely with a high-level business plan. Would love to answer any questions on that as well. We'll get into some investment highlights, a little bit of the property information, show you some of the comparables, both sales and rents, go through a little bit more of the investment projections, and we just touched on the management team as well. Next slide. So just an executive summary here. You can go ahead and click to the next slide, please. I know it's a little bit wordy, so I'll cover the bullet points on the previous slide. pleased to present Parkway Flats, which the beautiful community you saw on the intro slide is a Class A asset in West Houston's urban core, specifically the Energy Corridor submarket, where we see about 250,000 employees nearby. It's a 2017 construction garden-style apartment seated within a wealthy 1 mile radius or an affluent community. Typically see $92,000 of an average household income. And we're purchasing this community for $45.6 million, which is $152,000 or $152,000 a unit, which is actually a discount to the replacement cost should you build the community today. Working with George and his construction company, partnering with the brokers as well, we're able to come up with $180,000 as a replacement cost, which puts us close to $28,000 cheaper than if you were to build this property brand new today. Coupled with the upside I'm about to walk you through on the business plan, we think this is a great deal and we'll love you to take part in as well. It's also zoned to 2 of the top rated schools in Houston ISD. We believe this is a great asset as well. Next slide, please.
Sure. And then just to note here, this project was built in 2017, so it's only 4 years ago. So the fact that you can, that we're getting that discount price per unit now is pretty significant.
Mm-hmm.
Yes. And speaking of that being only 4 years old, we're purchasing it directly from the developer, which is kind of where the value add comes from. Traditionally, we see developers want to build the property and occupy it, and they manage more for occupancy than they do for the rate and pushing, which is where we come in as the owner operators. We want to push the rates and deliver, increase the NOI, increasing the value of the property, right? Really honing in on that force of appreciation. So just kind of running through this again as a high level with a lot of words, and I apologize for that. We're planning to upgrade the in-unit renovations on 200 of the 300 units as well, is where we see our value add plan. And currently we are 90% occupied with 99% pre-leased, and we're expecting to see that here within the next week. And like I mentioned, we're looking to do a 5-year hold with an 8% pref return to the investors, projecting an 11% cash on cash delivery with a 21% IRR projected. We have secured a 80-20 loan to value bridge loan with 3 years IO with 2 1-year extension options at a 3.4 plus the LIBOR floor. And next slide, please. Showing you a little more visual instead of a very wordy slide of what the value adds we see in unit. On the left here, you can see the kitchen and our bathroom, what it looks like today. We see all 300 units having black appliances. All 300 units are missing a kitchen backsplash. And all 300 units have Formica and a study area in the bathroom, where you can see our Alicio Briar Forest comp on the right there has those stainless steel appliances and the granite countertops throughout, and are achieving significantly higher rents in the same submarket. And another call out there is, as Sabrina mentioned, we are a 2017 year of construction asset, where Briar Forest is a 2014. So we're newer and cheaper, which seems to be a great combination for us to come in and complete these value add CapEx expenditures in the units, and then achieve those $100 premiums we're pushing for today.
Mm-hmm.
Next slide, please. Additionally, as a Class A asset, most of the tenants are used to having all of the amenities at their fingertips. Today, there is a pool in one of the courtyards, which we have plenty of pictures of. It's very beautiful. I hope you enjoy them. In this large grass area here you see on the left, while touring, the property management company mentioned that some of the tenants go out there and play soccer. They've used it for a couple of resident events, but ultimately at the end of the day, it's an open space with a lot of potential. Brainstorming with everybody on the deal, we've kind of come up with being able to create this outdoor common space and potentially upgrade the dog park as well, as that seems to be an amenity other tenants enjoy. And you can see here on the right, we're looking for that modern, chic, very Texas feel with some of the inspiration pictures there, looking to add maybe a pergola with a couple of hammocks, some outdoor seating and a fire pit for the tenants to gather and spend time with, really hoping to create that sense of community to hopefully, increase resident retention and lower turnover expenses down the road. Next slide, please. And I believe Charlie is taking over here,
Yep.
speaking a little bit more to the investment highlights and the surrounding area as well.
Thanks, Carson. So yes, as you're seeing now, I hope that you'll get an understanding that this is a pretty spectacular property. Houston, fantastic market. We're located over on the west side on the energy corridor. I think one of the things that makes this fantastic is that there's a limited supply in the submarket of where we're based, and as you can see, there's only 2 deals under construction with a 9-mile radius. That's going to allow us to continue to push rents because we're going to have less competition that's going to be coming above us. With projected rent growth of 4.6 and 4.4 respectively over the next 2 years, we've purposely, on a conservative manner, underwritten, only allowing for 2% and 3% on the second, third, and fourth years. So that showing what our returns are now, based on that, we hope to certainly exceed them based on those metrics. Next slide, please. As Carson had alluded to earlier, the property is located in a fantastic school district, one of the best ones around in the Houston ISD, and it's got high ratings on the 2 main schools within the zoning area of the property. This one just shows you on a slightly higher level, on 3-mile radius, the housing income and the household incomes that surround the properties. And then if you compare to the lower metrics within the 1-mile radius, we've got a $92,144 average household income from last year. And the average home value is $388,000, with a majority of 75% white collar jobs in the 1-mile area. So this absolutely highlights one of the reasons why we found this property so attractive.
Yeah, that was one of the things that really jumped out to me, was just the median income within that area. I mean, you look at typical averages in other cities, they're around 40, 50, 60s. This is a very affluent kind of high-end area. So perfect location right in the middle.
Yeah. So this slide kind of just gives you a little overview map of what is around, what's attractive in the area, the amenities, the retail, the restaurants, that kind of thing. As you can see, they're all in very close proximity to Parkway Flats. And Sabrina, if you can go to the next slide. This kind of gives you a more visual of what it is. You know, Topgolf, one of the biggest expanding experiential companies in the US at the moment. George Bush Park, you've got plenty of different parks, Tertiary and Miller Park, for trail running, playgrounds, gardens, all within a very short distance of the property. The next slide will show you the retail sectors. Oh, am I frozen?
You are frozen.
Sabrina, can you go to the next slide?
Can you guys hear me?
Mm-hmm.
Yeah.
Let's see. Oh, Sabrina, you want to take over and share your screen again? Sorry.
Yeah, I have no idea what happened, but I switched over to a secure Wi-Fi connection, so I'm so sorry.
No problem.
Sorry about that, guys. It's the weather. Created a technical glitch.
Actually, perfect time to quickly break and let those know who just joined. We are recording this, and we are not allowing questions for right now because we have so much to cover. So we'll open up to Q&A towards the end of the call.
Okay. So thanks, Sabrina. Just so going on from the amenities and what's around in the vicinity of the apartments, you've got the main city centre, Memorial City Mall, Town and Country village. You've got all the main anchor retailers, Barnes & Noble bookstore, restaurants galore. Truly, a fantastic amount of array and diversity available on your doorstep. And again, this is just a bird's eye view of kind of getting an idea of proximity and what really is and where it is, along with showing really also where the home values are in relation to what we, to where we're located. As you can see, nothing right next door, the Parkway at Elbridge, 1.4 million is a average home value. So that's the kind of area and the proximity of things to us that absolutely make this, not just from its age, but location, a Class A product.
Yeah, and to kind of focus on here too, you can see those home values, 1.4 in the neighborhood directly north of that, home values up to 2.2 in the Lakes of Parkway there. So for many of the people renting here, those types of homes are, those are beyond a lot of people's ability to get a mortgage on that. So this is more of a lifestyle type asset. People like the amenities, they like the location. So a lot of these people that are renting and, kind of our target renters, they come from the medical district or the energy district, and they may have a goal of eventually being able to purchase in this area. But right now, with how competitive it is, many of them are just happy to get a nice top of the line Class A asset, the amenities, the location that they want to be in. And without being able to purchase, they'd probably have to look further out, quite a ways north or east if they wanted to buy a house at this point.
I was just about to say that, Kyle. We're actually seeing that a lot here in Phoenix, and a lot of that is happening in really hot markets where people are exhausted from putting offers in homes, even with luxury homes. And so what they're doing is they're finding a rental in a place where it has good schools, is safe, is centrally located. They're renting an apartment for a year, 2 years until they're able to, make an offer on a home that they love. So like Kyle said, this is a lifestyle asset, and it's perfectly located for those who want the amenities and the benefits of the area.
So in terms of employment, this is really an ideal location. You can see this graphic here kind of focusing on kind of highly concentrated pockets of population for jobs here, but just within a 3-mile radius, you can see 94,000 jobs. We've got the energy corridor. Really a world famous area. Everyone knows Houston for kind of that energy sector, but we've also got the West Chase district, which we'll talk about, Memorial District, which has a huge amount of employers and jobs there as well as the medical district, which is kind of in the northeast corner, not quite on this map, but we'll talk about that as well on the next slide. So yeah, if you look at these employers, you've got 4 Fortune 500 companies just within the first 6 miles, which is almost unheard of. So you've got Philips, Cisco, Conoco, Halliburton, just major employers that are, driving people there, expanding their campuses. In total, Houston has 24 Fortune 500 companies at the moment and growing. So this is really a massive employment center. You can see other companies like Waste Management, Hewlett Packard, Kinder Morgan, ExxonMobil has a huge campus here. So just a really expansive and diverse employment base here. Go to the next one. And the energy corridor, again, we talked about it, but most people have heard about this, but 94,000 employees from many of these same companies that are pretty well known, BP, Conoco. But it's not just energy. You've got engineering companies, finance, healthcare. So it's really starting to diversify. And a lot of these companies are looking towards longer term, sustainable, kind of green energy. So it's not just kind of the, historical oil sector as we think about it. It's really changing and adapting. So we'd like to see that. And then the West Chase district, this is really a little bit more kind of high-end office, kind of a mix, pretty diverse mix of employers here, but again, 93,000 employees, and just, a few miles away from the property. Go to the next one. Memorial City, kind of a more traditional, kind of your office, commercial space, a lot of new development happening here. You can see some of these state-of-the-art office buildings, really, really popular place. You can see some new campuses going in here as well. So this is a very, very popular place for employment growth. Go to the next one. And then lastly, Galleria. This is a very high-end part of the city, kind of very well known. You've got 37 hotels here in the area, a lot of tourism, So just kind of the center of the city. This is where people want to be. And again, this is very close to the properties. This is very attractive to people to want to move in. And then, we mentioned healthcare, and it's really good to see an economy that has such a strong healthcare sector, because we know that's not going anywhere. It's going to continue to expand. And really, there's 5 major, well-known, state-of-the-art hospitals within this corridor here, just a few miles to the north. You can see the names of these hospitals here and kind of the volume of people who work there. So when you think about our tenant base, these are perfect renters for us. They're medical staff, nurses, doctors, all those people working there that are looking for the type of quality kind of asset that we have. So, and again, just a couple of the other hospitals there in the area. So throw it back to Carson to talk about the property a bit more.
Thank you, Kyle. Jumping in, just a quick snapshot of what the property looks like today. Here's a quick aerial view, and you'll notice that there's a billboard on the property, which we are receiving some income from as well. Next slide, please. Here's a breakdown of the floor plans, 300 units, good mix of 1, 2, and 3 bedrooms, primarily 1 bedrooms, followed by 2 bedrooms being the second largest, and then 3 bedrooms, obviously being the smallest mix there. Next slide, please. So touching a little bit more on the aerial photo, there are 11 buildings on this property, again, built in 2017. There's 11 residential buildings, pardon. 1-story clubhouse has leasing office. It's very modern. We do have some pictures coming up as well. There's a fitness center, 1 maintenance shop, 1 mailroom, and 5 detached garages. The construction was concrete post-tension slab with some hardy plank and brick siding. All the roofs are pitched, and there has been no hurricane damage since construction was completed, so they are in good shape as of today. All of the bedrooms have carpet in them with a vinyl wood plank inside the kitchen and the living room areas, with the tile being in the bathrooms. The concrete paved with curves is what the parking lot looks like. You have some copper wiring and PVC, being a newer build, meets all the building codes that have been passed since then, with fire sprinklers in all the units. Plenty of parking on there, with charges being assessed to the garages and the covered parking. The garages there today are 100% leased, and are renting anywhere from $95 to $110, and then you're seeing your reserved spaces for $20 and your covered spaces for $40 on average. Next slide, please. Just a couple pictures of the insides. This is one of the model units. You can see the LVP I mentioned across the entirety of the living room area and the kitchen there. All the units do have washer dryers in them, owned by the property. And then you can see, again, the black appliances, the lack of a backsplash in the kitchen, and in the bottom right picture, you can see, again, the Formica countertops in the bathrooms as well. All the units have a patio on the first floor, a balcony on the second and third floor. They have kitchen islands, a study desk as well, walk-in closets, stand-up showers, garden tubs, everything you'd expect in a Class A asset as well. Next slide. Looking again at the community amenities, it's a little bit more of a lifestyle product. Mentioned you want to live at a place you can enjoy. You can see they have the sparkling swimming pool on the top right. They have a 24-hour fitness center there that looks over the Tranquility Pond, as well as the pool itself. In the bottom left, you can see the clubhouse. Again, very modern design, very open space, great for the residents to come into or potential tenants. You can see the pond there that you have some units overlooking, gives you a nice view. And an outdoor grilling station as well. It does have a smoker. The developers with Abacus really do enjoy that, so that's something they like to put into a lot of their properties. It's a good, unique addition to the property as well. Next slide, please. Here's a couple more pictures. Again, you can see the garages, the carports, the dog park on the right, a picture of the mailroom. And then in the middle there, it's different views of the clubhouse and the business center as well. Next slide. Kind of touching a little bit more on the rent comps here today. As I mentioned when comparing it to Briar Forest earlier, you can see there's large deltas versus even San Montego on the 1 bedrooms. And then $200 on the 2 bedrooms, and then close to $300 or $400 on the 3 bedrooms as well. Again, the big call out here is there is room to grow without CapEx, and we plan to push rents before we completing any of the upgrades. But again, we are the newest product in the market and are the cheapest on the absolute rents and a per square foot basis in almost every case. Next slide, please.
Yeah, kind of think about that, just put it in perspective. I mean, think of how rare that is. You have an almost brand new asset where older properties are even getting more in rents. And, from our perspective, it sounds like just the initial developer, that's not really their focus and knowing how to push those rents and kind of get to that point. So to find something like this in this area with room to grow and some additional value adds is really like a unicorn. So we're really excited about that.
Well said.
Yeah.
Here's another map of some of the rent comps we looked at as well. You can kind of see how close they are in proximity. Next slide. And we are purchasing this, the trailing 3 cap rate is a 4.1. And you can see ours there on the map in bold on the left side. One thing I did want to call out is we know going in cap rates being low scares a lot of investors, but this is partnering with Newmark, who's the brokerage on this deal. We were able to, who covers, 90% of the sales in Houston. We were able to find out that they've been selling Class A assets at a sub 4 cap rate for the past 3 years, pre-pandemic, pre-interest rates dropping. So again, just a reminder, we're buying Parkway flats at $152,000 a door at a 4.1 cap rate. Excluding Parkway flats, the market cap is a 3.7 and about $180,000 a unit. This difference on the basis is close to $29,000 and is why we believe this is such a great deal. With Houston's population and companies continuing to move to Texas, we expect for renters or apartments to continue to be in high demand as people flood to the city before the supply of homes can keep up, right? Continuing to rent our properties, allowing us to push rents as well, and then continuing to exit our cap rate, which we have projected as a 5. Next slide, please. Getting a little bit more into the projections, we're targeting a 3 to 5 year hold. Again, we have a 3-year bridge loan with a 1+1 extension options, projecting to exit at a 5. As I just mentioned, this is very conservative, almost 1% higher, but we know market factors are continuously changing. We want to be as conservative as possible. We're projecting a 21% IRR and ARR, and an 11% cash on cash return as well. Next slide, please. Here's a 5-year pro forma of what we're looking at. We partnered with our property management company, Asset Living in Houston, to come up with our expenses and develop a concession burn-off plan. As Charlie mentioned earlier, looking at axiometrics, we expect the vacancy to stay around where it is today. We're budgeting for 6%. As I mentioned, the property is currently leased at 99%, and by the end of June, we're expecting to have 2 empty units on the entire property. And all of this together over 5 years as we continue to pay out our 8% preferred return, giving you that average cash on cash is 11. We are looking to refinance in year 3, which is when we will see a large return of capital as well. Next slide.
I mean, just think about that. 300 units this property has, and only 2 will be vacant by the end of June. That's wild.
A little bit more on the partnership structure and fees. Again, I mentioned the 8% pref to all the investors. When we refinance and disposition, we'll look to return all the capital, and then any excess proceeds on top of the 8% and the return to capital, we will then split 80-20, 80% being to the limited partners as well. The fees we're building into this is 2% acquisition fee, so 2% of the purchase price, and then an asset management fee of 1% year. Next slide, please. And one of the biggest drivers on the day-to-day is our partnership with our property management company, Asset Living. Ian and George and myself and Megan have a very close relationship with the VP of Acquisitions, JC Reeves. He's personally toured the property multiple times. He was out there for due diligence, and his team. They are one of the 15 largest property management companies in the US, managing just over 32,000 units. They do business in 9 states, but more importantly, they are local to Houston and are right down the road. They know this market like the back of their hands. The budget we've put together is based off of other assets that they run in Houston as well. So they feel very confident in the business plan that we can achieve what we set forward. And is one of their babies as well, with a nice Class A property they'd love to add to their portfolio as well. Next slide. And I believe I passed it over to Sabrina here.
Yeah, all right. I know you guys must have a ton of questions. We just wanted to quickly present to you the options that you have if you are interested in investing. So right now we accept individual cash, we accept self-directed IRAs, accept solo Ks, other entities, so like LLCs, trusts, other funds, and then also we accept 1031s. We are looking for a $1 million minimum for 1031s though. And then we have two options to invest. One is as a limited partner through Syndication Pro, which most of you are familiar with, which we can go into detail during our Q&A. And then second is our Saber Equity Diversification Fund, which Kyle will be explaining.
All right, so yeah, as Sabrina mentioned, we want to give people a new way to invest. So this is really a first of its kind fund. Many of you have heard of funds. We're not the first people to come up with a fund, but many of them are known as like blind pool funds, or you invest with a syndicator, and then you're essentially giving them full control to invest in properties that they like, and they're kind of along for the ride. And there's some great funds out there, but kind of this new model, we're partnering with another firm called Investor, and together we've created this basically this new platform that's more similar to like a trading account for those of you who may have traded with Fidelity or TD or Ameritrade. So not exactly the same, but similar in concept. So the idea is you can invest into the fund, and then as we, Saber Equity, add more deals to the mix, you can pick and choose which deals that you'd like to invest in within the fund. And what it does is that it just gives you more diversification, hence the name Diversification Fund. 50,000 minimum for the fund, but once you're in, you can actually purchase slices in $10,000 increments of the different deals we have. There's the maximum really depends on the deal, but you have quite a bit of flexibility there. And then really one of the most unique things is for those of you who've invested in lots of kind of separate deals before, kind of call them more traditional syndications, you get a K1 for each deal. You may get like a quarterly update from the sponsor. So it's pretty limited information, and it's all pretty manual in terms of kind of how you aggregate that together if you're in multiple deals. But what we're doing is doing a combined consolidated K1. Your account is updated daily, which is really, again, the first of its kind. So you can see all transactions in there, both on a per deal basis or on an aggregate basis. And it's just we just want to give people kind of a new way to invest. So there's no right or wrong. It really depends on your preference. And I know there's probably going to be a lot of questions on the funds. We're going to be doing a follow-up in the next couple days with a lot more detail of video to go over all the details of the fund, answer all the questions. So for the sake of time, we'll save any more questions on the fund, and you can email us directly. We'll tell you how to kind of take a look at that, but just kind of wanted to give a sneak preview of that tonight, because that is going to be a way for people to invest in Parkway Flats new funds. So.
And Kyle, if I can just add, what are the beauties of this fund is that it's fully customizable by the investor themselves. Most funds out there rely upon the investment managers to allocate the money how they see fit. While we find the deals and we source them and we put them into our fund, it's up to the investor to invest in them. So it gives them complete autonomy and control of how they are investing their money, which, as Kyle says, is the first of its kind, which is why we jumped on board with this, because this is going to be the way of investing for a lot of investors, the way of the future. And it won't, right now it's probably only available for real estate. Wouldn't surprise me that it'll go into other asset classes and industries pretty rapidly.
Mm-hmm. And in general, so either way you invest, it's going to be online based electronic signature. But again, there's kind of just two avenues, and contact us, set up a call. We kind of walk you through pros and cons, walk you through what those next steps are for those of you that are interested. But we do have a lot of interest in this. We expect it to go pretty quickly. So really encourage you to reach out, after today's call with questions and to talk through it with us.
Yeah.
All right. And I think that's pretty much all we had. I definitely want to open this up to questions. I know there will be a ton. I guess.
So we can open it up to questions. I think that's what you were saying.
Yeah.
We were losing you a bit there.
Can you hear me now?
So if you want to either, do you want to just do it in the chat box or as in the Q&A box, or?
I saw someone, looks like Evan had a question about minimum, which we talked about 50,000 minimum for this deal, accredited investors only, to achieve those projections that we talked about. And again, those are just projections subject to change, but based on current underwriting, that's our best assumption at this point.
Any other questions? So this is a 506c offering, which is therefore only open to accredited investors. If you're unsure what that means or whether you qualify, feel free again to either let us know or put it in the chat box, and we can help you out and make sure that you are qualified. Our fund is also a 506c offering. So in order to get into the fund, you need to be accredited. That doesn't mean to say that all of the deals in the fund will be 506c or require accreditation. That's one of the beauties of being able to do that. But again, there's more information on that for another time.
All right. Thanks, everyone. So Sabrina, you'll be sending out a follow-up email to everyone in the group, is that right?
Yeah, so I'll be sending out an email with the webinar, the keynote that we just went over, and then the link to Syndication Pro, which will have all of the documentation for the deal, as well as a link if you guys are interested in the fund to consult with Kyle, Charlie, or myself. Any last minute questions? All right. Thanks, everyone.
Is there a cash flow split above the pref?
Thanks for the question, David. As of right now, it's set up as the pref is the 8%, and then once we pass the 8%, it's 80-20 to the LP, 80% and then 20% to the GP. So just one step.
Any other questions? The time is for you guys. Feel free to use it.
All right. Thanks again, everyone. Look forward to more questions as they come.
Okay. Yeah, look forward to hearing from
Good
you.
night.
Thank you, everybody, again. Have a great one.
Thanks. Take care.